Good Friday morning, 30 minutes until the start of trading here in New York City. I'm Matt Miller. Dani Berger is on assignment. Bloomberg Open Interest starts right now. Coming up into Hollywood, earthquake as Netflix snaps up Warner Brothers for $72 billion in a cash and stock deal. Also, the Fed is poised to cut rates again next week as worries mount over a weakening job market. BlackRock's Rieder shares his outlook with us today. And the pressure is on in Washington. Democrats force a vote on extending health care subsidies after the shutdown deal. We'll ask House Minority Leader Hakeem Jeffries what's at stake in just a few minutes' time. First off, let's take a look at the big deal that broke about 2 hours ago. Netflix right now trading down about 3.33% after it said it is buying Warner Brothers Discovery in a deal that combines the world's dominant paid streaming service with one of Hollywood's oldest and most revered studios. Warner Brothers will complete the planned spin-off of its networks division, Discovery, which includes CNN, TBS, and TNT. So Netflix may not get Animal Planet, but it will get that beautiful studio in Hollywood, California. For more on the deal, we're joined by Bloomberg Intelligence media analyst Geetha Ranganathan. And Geetha, is that really what this big multi-billion-dollar deal is all about, getting that lot?
Oh, absolutely. It is. It's a huge lot, 100-acre lot. And really, this is about, owning one of the best and biggest studios in Hollywood. And Netflix really playing the long game here, a very defensive move by Netflix, looking out over the years, kind of really beefing up their content library and adding all of that prestige content to their service.
So tell us about the mechanics of this deal. I know yesterday we were talking about Paramount offering a $5 billion breakup fee. Now I'm hearing that Netflix has offered a $5 billion breakup fee. And that's not insignificant considering the fact that we've already heard concerns out of Washington about these two, big streaming players getting together and maybe amassing a little too much power in that market.
Yeah, I mean, antitrust is going to be a huge concern, Matt. No doubt about it. It's a $5.8 billion breakup fee, one of the highest in all of media transactions that we've seen. But Netflix saying all the right things. They're saying that they're going to do things that are right for the consumer, provide more consumer choice, sell both the services, HBO Max and Netflix, at a discount for consumers, keep movies in theaters. Now, again, that goes against what Netflix has always said, releasing movies first to streaming. But now they're saying they're going to keep, movies in theaters. And then also saying that as far as the studio is concerned, majority of Warner's revenue, or at least 40% of it, comes from licensing to other platforms. They said that they will continue to do that. So far they're saying all the right things that should placate regulators, but we have to wait and see how this all actually plays out.
All right, so let's talk about the other big bid. Paramount Skydance, according to CNBC, had offered $30 a share. That's more than the $27.75 that Netflix had offered. But I know, because I've been listening to you, Geetha, all morning long, talk about this deal. That would have been for the entire asset, right? And in this case, in the Netflix case, Warner Brothers is first going to spin off its cable assets. That's valuable to shareholders before it sells the streaming assets and the studio to Netflix.
You're absolutely right, Matt. So the $30 was for the entire company. This $27.75, or close to about $28, is just for the studio and streaming business. So obviously the board and David Zaslav, as they were evaluating all options, thought that the global networks business, or the TV networks business, is worth more than $2 or $2.25 a share, and obviously in the best interest of shareholders that the studio and the streaming business goes to Netflix.
By the way, we've long talked about the closeness of the Ellison family to Donald Trump and this administration. That was thought to be an advantage. Is anyone in Hollywood, is anyone in Washington saying it still could prove out that somehow this administration sees to it that antitrust concerns scutter the Netflix deal? Warner Brothers gets the $5 billion breakup fee, and then Paramount swoops in for the assets.
oh, anything is possible. And this hasn't been anything short of a soap opera here. So I wouldn't rule that out, Matt.
All right, Geetha, thanks very much. We'll continue talking to you about this deal throughout the day. It is an absolute monster. Geetha Ranganathan there of Bloomberg Intelligence. I have to say, it probably touches everyone, too. Everyone who consumes entertainment, which is most people, watches either Netflix or HBO or both, and soon they could become one. Let's turn to tech now, away from media. Hewlett-Packard shares dropping pre-market after sales of its AI server business fell short of high expectations. The company did say, however, it continues to see, quote, substantial interest in the business. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, what does that mean, substantial interest in the business?
It means they actually had to push back some revenue into the next fiscal quarter because the government was in shutdown, and maybe that impacted a few of the sales. But it did protect the margin a little bit. Remember, AI servers, they're not the most lucrative, profitable business because memory chips are getting so expensive. The things you put in servers are getting so expensive. We've seen that with Dell, now HPE, reiterating that. That's why they bought Juniper. That's why they're looking at the networking side of the equation, and why actually BI has been liking the fact that they're getting a more diversified model, more diversified business, and they're looking to grow there more broadly. But yeah, look, we had very high expectations for HPE. It's been caught up in the whole AI frenzy and optimism that many more companies can benefit from the AI infrastructure build-out. But we just have to wait for a little bit for the next quarter, it feels like. For here and now, though, we did see some support more broadly for its margin, and we are seeing that actually 14% growth in revenue ain't too bad.
All right, so that's the Hewlett-Packard story. There's a lot.
Not Hewlett-Packard. HPE.
Sorry, HPE story.
Rebrand.
I got it. And no, and I get stuck in my ways as an older man. But you're right, HPE. That's the HPE story. We're going to continue to stay on top of that. You'll be covering that with Ed Ludlow in your program, Bloomberg Tech at 11. But there's a lot going on in tech this morning. I woke up to a Chinese IPO, which normally I don't pay much attention to, and I hadn't really heard, I will say, of more threads. But this is apparently a challenger to Netflix, to NVIDIA, that the market is taking seriously.
Was it the 450% pop on the IPO that caught your attention?
Yes.
I mean, it's a record. We've never seen an IPO enter that market with such a fanfare. It only raised $1 billion, but the fact that it crescendoed ever higher and it's now worth about $39 billion, I mean, nothing in comparison to NVIDIA's overall market cap, but still, this focus that China doesn't want NVIDIA chips, wants to grow domestically, so the government wants at least. So you've got CameraCon that's been doing incredibly well in the public markets. We've seen, of course, now Huawei do well. We know that other Baidu, for example, is thinking of spinning off its chip-making part of the business and indeed listing it. Others are waiting in the wings. Meta X Integrated Circuits, other companies over there are thinking this Star 50 index has got a lot more lucrative for non-profitable companies that are looking to innovate where the government wants to innovate. So if you're thinking about quantum, if you're thinking about AI infrastructure, you're going to be able to potentially raise some funds. So absolutely stellar performance. And we'll just have to see how that benefits, because I think it was 2,000 times oversubscribed for the retail part of the overall offering.
All right, so one of the other big stories, now there's a lot that you guys are trying to squeeze into your hour today, but obviously media and tech go hand in hand. You guys had such incredible coverage of the Screen Time event with Lucas Shaw. We're hearing today that Meta is going to be expanding Meta AI with real-time news sources. They've made partnerships with CNN, Fox, Le Mans, People, The Daily Caller, The Washington Examiner, USA Today, and others. So this is your worlds coming together. This is tech and media really colliding, isn't it?
And again, because remember, we used to have pretty lucrative deals for publishing industry with Meta, but they folded that and the news tabs back in 2022 or so about, well, at least the payments folded in 2022 and they shut down the news tabs a couple of years ago. But now we're seeing them having to pay out and make these commercial relationships once more. They actually did one with Reuters back in 2024 because you and I need real-time answers to our chatbots. It's no good having something that was trained on the internet a year ago. They need live and contemporary, I'm not even going to say that word at this time in the morning, but real-time answers to not just your business news, but your fashion, your entertainment more broadly. You want international news, why they go with Le Monde. And it's interesting that they're going across the gamut in terms of political perspective here, right? Because they were criticized back in 2016 of not having enough conservative voices. They did have Breitbart and others linked into their news offering previously, but the fact that they've gone with Fox, the fact that we've gone across the gamut, these are going to be costly for Meta in the same way that Perplexity is having to pay off and some of the others are. But I think it's going to be much more beneficial for you and I, the consumer.
All right. I just want to finally talk about the New York Times suing perplexity over use of its copyrighted work, because this is the same story essentially, except they didn't make a deal, right?
Yeah. And New York Times has been relatively litigious against large language models. Yeah. Equally, Perplexity has come in the line of fire with cease and desists from across the board. Poor Perplexity is getting in being targeted by Amazon as well, because it's been trying to allow its chatbot to be able to make purchases on other particular websites. So this is the beginning of companies trying to work out who's got whose real estate, who's ensuring that they're training and giving fair royalties back when necessary. And once again, Perplexity has been trying to make these commercial deals itself, but clearly not quite quickly enough.
So funny, I was talking to Matthias Dupfner about this like 10 years ago, and I figured it would be resolved by now, but this is an issue.
Not evolution, Matt. It's a revolution.
All right, looking forward to your program. Caroline Hyde hosts Bloomberg Tech. That kicks off at 11. They've got a lot to squeeze in on that show today, so definitely tune in. I want to check in right now on futures. We are about 20 minutes away from the market open right now. Not seeing decent gains right now, little change on the S&P 500, but we're so close to a record. If we do manage to rally into the close, which has been known to happen on a number of occasions, although it is a Friday, we could get a 0.5% gain. That would push us to another new record for stocks. I'm not saying it's going to happen. I'm just saying we're close. Let's get a check at some of the other movers on our radar. Ulta issued a beat and raise as demand remains robust, but the cosmetics company's CEO cautioned that consumers are getting choosy. So Ulta Beauty this morning up 7.3%. Speaking of beauty, Victoria's Secret also beat earnings and raised its outlook as its turnaround strategy seems to be luring more shoppers across all income levels. This is a huge story of a once giant in the lingerie world that has come crashing down with competition from startups like Skims. Today up almost 16%. And cybersecurity firm Rubrik is jumping after posting a surprise profit in the third quarter. Rubrik up right now more than 20%, increasing its market cap by a fifth. Coming up, a Bloomberg exclusive, House Democratic leader Hakeem Jeffries joins us right here on Bloomberg Television to discuss the battle over health care subsidies and whether New Yorkers could see higher taxes again next year. This is Bloomberg. All right, let's head now over to Capitol Hill in Washington, D.C., where Bloomberg's Balance of Power co-host Joe Matthew has an exclusive interview with the House Minority Leader Hakeem Jeffries, and they'll be talking about health care.
Indeed. Thanks for joining us live from Capitol Hill on Bloomberg TV and radio. I'm Joe Matthew with an exclusive conversation with the Democratic leader in the House of Representatives, Hakeem Jeffries of New York. Leader Jeffries, thanks for being back with us on Bloomberg. It's good to see you.
Morning, Joe. Good to see you.
Pretty important ruling in the Supreme Court when it comes to redistricting in the state of Texas that I'd like to start with here. It's open season, apparently, on redistricting. Does that mean every Democratic-led state in the country needs to redraw their maps?
Well, first of all, it's unfortunate that the Supreme Court has rubber-stamped a racially gerrymandered extreme map that Donald Trump ordered Texas Republicans to engineer as part of his effort to try to rig the midterm elections in 2026. But notwithstanding this adverse ruling, we're going to continue to move forward and ensure that there is a fair map across the country. California voters enacted Prop 50, and as a result, we'll have a fair map in California with some additional opportunities to be competitive. And I expect that you'll see other states across the country continue to respond.
Will yours be one of them? Are you on the phone with Governor Hochul today saying it's time to redraw the New York map?
Well, the New York map has some particularities relative to the Constitution that won't necessarily allow it to be revisited in this particular cycle. But some voters have filed a lawsuit in New York, and we're monitoring that litigation closely to see what the outcome may be.
Okay. There's a question about whether you really need it. Leader Jeffries, after the special election in Tennessee on Tuesday, we saw a plus 22 Trump district go down to a plus 9 Trump district. And you've got a lot of armchair mathematicians out there suggesting that could mean as many as 30 or 35 seats for Democrats in the midterms. How do you see it?
Well, Republicans know that if the elections were held today, they would lose. That's the reason why Donald Trump has decided to engage in this extreme effort to gerrymander congressional maps all across the country, and it's very unfortunate. Our view is that we're not going to unilaterally disarm, and we have to ensure that there's a fair map nationally across the board so that it's the voters who get to decide who is in the majority after the November 2026 election. Part of the challenge with Republicans is that they've broken all of their promises. They indicated that they were going to lower costs. In fact, lower costs on day one. Costs haven't gone down in America. Costs have gone up. Housing costs are through the roof. Grocery prices through the roof. Electricity bills through the roof. And now, because my Republican colleagues refuse to extend the Affordable Care Act tax credits, we know tens of millions of people are about to experience dramatically increased health care costs. Democrats are actually the party focused on driving down the high cost of living.
So let's talk about a couple of those points of leverage that you just pointed out. Affordability and health care. Many would argue that it's kind of the same story here. President Trump has been saying that affordability is a Democrat hoax, a Democrat con job. Does that mean you do not have Republicans on board with you in reforming health care or extending Obamacare subsidies?
It appears that way. It's unfortunate that the president's position, which is the Republican Party's position, is that the affordability crisis in the United States of America is a con job and it's a hoax. No, what was a con job and hoax was the fact that Republicans spent all of last year claiming that they were going to lower the high cost of living in the United States of America, that they were a party committed to addressing the inflationary pressure that the American people were under. That's all they talked about last year. But they lied to the voters. That's the con job.
They lied.
They absolutely lied to the voters because there's no evidence throughout this year that they've had any intention to actually address the affordability crisis that exists. In fact, they now say it's all a hoax. But everyday Americans, when they go to the grocery store, the supermarket, when they see their health care premiums dramatically increasing, when they see the electricity bills that they have, which are through the roof in part because Republicans in their one big ugly bill attacked the clean energy economy at a time in America where we have growing power needs in terms of what we see with the expansion of artificial intelligence. Yeah. It's all extraordinary. So Republican leadership has made it clear they have no intention to extend the Affordable Care Act tax credits, and that's very unfortunate.
You know, the White House would say, hold on, Leader Jeffries. This president's been working overtime to cut deals to lower the cost of prescription drugs. Does he deserve credit for that effort?
We haven't seen any evidence that prescription drug prices have gone down in any meaningful way. What we have seen are that the Trump tariffs are out of control. They've increased costs by thousands of dollars per year on everyday Americans, and they've created an uncertain environment for businesses and corporations throughout the country. And we know that uncertainty is one of the biggest problems that American corporations and companies may face. It's difficult to actually make investments when you have this chaotic environment that has been visited upon the economy.
So let's talk about what you can get done before the expiration of these subsidies at the end of the month. A bill was introduced yesterday, a framework that was bipartisan. A Democrat and a Republican, Gottheimer and Kiggins. It would extend these subsidies for a year and put new collars on eligibility. Is this a path to renewal in your eyes?
Well, we'll have to take a look at the particulars in the four corners of that bill.
Yep.
214 Democrats have signed a discharge petition that will extend the Affordable Care Act tax credits for 3 years and give the American people the certainty that they need in order to move forward during these otherwise uncertain times. All we need are 4 Republicans. There are 219 of them. All we need are 4 House Republicans to join us, and we can extend the Affordable Care Act tax credits. We also want to take a look at what happens in the Senate. I'm thankful for Leader Schumer and Senate Democrats who will put a bill forward next week and force an up or down vote on an extension of the Affordable Care Act tax credits. You know, we're in this fight until we win this fight on behalf of the American people, because in the wealthiest country in the history of the world, it cannot be the case that working class Americans and middle class Americans are unable to afford to go see a doctor when they need one.
Are you in touch with the Speaker of the House on this? Is Mike Johnson talking to you about a potential vote after John Thune promised a vote on health care in the Senate for next Thursday?
You know, the big challenge with House Republicans has been that they've adopted a my way or the highway approach. They have zero interest in actually sitting down and finding a bipartisan path forward. We've said from the very beginning of this year and throughout the Trump Republican shutdown that we will sit down with anyone, anytime, any place here in the Capitol or go back to the White House, sit with the president to try to figure out how we can fix our broken healthcare system and address the Republican-created healthcare crisis that's devastating people all across America. They've refused repeatedly to sit down and even try to find common ground, apparently because they really are uninterested in dealing with an extension in the Affordable Care Act tax credits. Joe, as you know, this is the same group of people who have actually tried to repeal the Affordable Care Act more than 70 times over the last 15 years.
So could we be in a world in which there's a health care bill that passes the Senate and dies in the House?
Well, if there's a bill that passes the Senate, there will be tremendous pressure on Mike Johnson, Steve Scalise, and House Republicans to bring that bill to the floor for an up or down vote. And the votes will exist in the House of Representatives. I call upon some of my Republican colleagues, more traditional conservative colleagues, or the so-called swing seat Republicans, to actually press their leadership to give the people of this country an up or down vote on something meaningful that will extend the Affordable Care Act tax credits.
Just lastly, President Trump today will be receiving, we understand, the inaugural FIFA Peace Prize. Does Donald Trump deserve credit, as he says, for ending 8 wars?
Yeah, it's unclear what 8 wars he's talking about. What the American people clearly want to see from this president is action related to the challenges that we face in this country, lowering the high cost of living, fixing our broken healthcare system, making life better for everyday Americans. That's the Democratic commitment, that we actually should deliver on the promises that Republicans made to lower the high cost of living, but refused to address. In a country that's the wealthiest in the history of the world, but there are far too many people who are struggling to live paycheck to paycheck, can't thrive, can barely survive. And that should not be the case in this great country. We should allow for a situation where every single person who works hard and plays by the rules can afford to live a comfortable life, live the good life, good paying job, good housing, good health care, good education for your children, and ultimately, at the end of the day, a good retirement. That's the American dream. We need to bring it to life for every single American.
Democratic leader in the House, Hakeem Jeffries. Leader, thank you for being with us today once again on Bloomberg.
Thank you.
We'll send it back to you in the studio.
Joe, thanks very much. Joe, I just wonder, while you were talking to Hakeem Jeffries on Fox Business, House Speaker Mike Johnson was saying that the Republicans will roll out a health care plan probably mid-next week. I know because I listen to your program every day that we don't have that many legislative days left.
That's correct.
On the calendar. What is it, like 10 days left, and the Republicans are going to come out with a plan mid-next week? Is there enough time to get anything done?
That's a great question, and we could be in a situation, and we'll talk to leadership about this, where there is a short-term fix because, Matt, as you point out, time is tight, and these Obamacare subsidies will expire at the end of the month. If there is, in fact, a Republican plan, we'd love to know what the details are. There was a bipartisan bill, as we just discussed, dropped yesterday, but there's no path to freedom at the moment on this, Matt, and if it waits until next week, we're going to have single digits in terms of legislative days left to make this work.
All right, Joe, thanks very much for that. Joe Matthew there, anchor of Balance of Power. His show kicks off on Bloomberg Radio at noon, then again on Bloomberg Television at 1 p.m. Let's take a look at what's going on in these markets. Just about 4 minutes left until the opening bell. And there's a very special guest ringing the bell down at the New York Stock Exchange, so stay tuned for that. We're looking at S&P futures right now that are a little changed, but the arrow is green here, 0.1% the gain. We need to see that move up to about 0.5% before we hit a new record on stocks. NASDAQ up a little bit more, about 0.2%. You can see the small caps this morning down 0.2, even though it looks even more like we're a lock for a cut from the Fed next week. We get a ton of data coming out at the top of the hour. And when we come back, we're going to talk to BlackRock's Rieder as well. This is Bloomberg Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at markets that are hovering between gains and losses. Right now, green arrows on futures, 0.1% on the S&P, 0.2 on the NASDAQ. If we do get up by 0.5%, by the time we close, we'll have hit another all-time record high on the S&P 500. So stocks, although November was a tough month, we've wavered. We're back up there at new records. I teased a special guest at the New York Stock Exchange ringing the opening bell. And it is special to see Brad Jacobs here. He's got a new book out, How to Make a Few More $1 Billion, and he runs QXO, and it's a company that we talk about all the time. But I had accidentally looked ahead on the NYSE website, and I thought that Hank Azaria was going to be ringing from, Mo Sizlak of The Simpsons. But that's actually tonight. So he's ringing the closing bell. Stick around for the close with Romaine and Katie, and you'll see the voice of Apu ringing the opening bell. It's a SPAC at the NASDAQ market site, so that's pretty much all you need to know. In terms of the big news today, we had what could prove to be an historic deal. Netflix is buying Warner Brothers in a $72 billion deal that combines the world's dominant paid streaming service, that is Netflix, with one of Hollywood's oldest, most revered, and most iconic studios, Warner Brothers. It is a fascinating deal, and right now you've got Netflix down about 4%. Warner Brothers Discovery up 324 to 25.34. So the price actually is $27.75. That was the agreement. We're not quite there yet, but we're getting ever closer on WBD. And apparently Paramount had made a $30 bid, but that was for the whole company, and Warner Brothers is going to split up for the Netflix deal. This is a story we're going to continue to cover with you. But I want to get to the broader markets, and we have a Fed meeting next week, and there's a lot going on in rates as well. So let's bring in Rick Reider. We have a ton of economic data coming out at the top of the hour, Rick, and normally we would have also jobs day today. That's going to be pushed forward a couple of weeks, or back a couple of weeks, I should say. And this leads me to my main question. Why would the Fed meet next week if they're not going to get the big jobs number out until after their meeting? Why not delay your Fed meeting, break up your precious schedule, get a little closer to Christmas? I get it. Everyone wants to be home for the holidays. But isn't the U.S. economy important enough for them to do that?
It's a great question, Matt. I mean, listen, I would say one thing. I think there's not a lot of ambiguity about the velocity of hiring in the United States today. I mean, you see, obviously, we got the ADP data, the claims data we got yesterday, but that's pretty ambiguous because of the timing around the holiday. But boy, you see it in terms of where companies are going. I mean, literally every day. And you see, by the way, on the backside of M&A, to me, it's pretty clear that we don't have any hiring velocity today, and that the Fed, I think it's a pretty clear, you got to get that funds rate closer to 3%, if not at 3%. And so I think you've got enough data to do that, and you don't have enough data that suggests that inflation, certainly over the intermediate term, is accelerating. So I don't have any issue with the meeting. I mean, I think they can move closer to 3% sooner. So, and I think you got enough data to allow you to do that.
All right, so you think it's a lock, and it doesn't really matter. They might as well cut now if they're going to cut.
By the way, I don't think it's a lock. I actually think, when you look at, we're going to probably have some dissents. You probably have a disagreement. I think it should be a lock. Listen, I think the fact that we haven't heard anything otherwise, that they're probably going to go. But I definitely don't think it's 100% that they're going to go.
All right. That's interesting. So you think we're going to see more dissents. Does that continue, Rick, or do you think, once Jay Powell is done and the president puts in whomever his pick is for Fed next year, that we're going to see less dissent, or is this a new feature of the Federal Reserve?
So I don't personally, I don't think it's a crisis that you have some disagreement. You have some independent voters, you have some independent people on that Fed that are interpreting the data differently than others. So I'm not sure that it's a structural problem. Listen, I think that, to me, the data is very clear that inflation is a bit elevated today, but productivity and innovation will deal with that. And that is so clear to me. And then the flip side of that, productivity and innovation, are creating an incredible lack of hiring for ordinary jobs, lower skilled jobs, et cetera. And so, how people interpret the data in the near term, I don't think it's a structural issue that you have those dissents. I just think going forward, that we're going through what I think is the most extraordinary industrial revolution we've seen maybe in a generation, and I think the offtake of that is pretty clear in terms of what it means for jobs and inflation.
Let's talk about the next Fed chair. I mean, reports suggest that Kevin Hassett has won this contest, and I wonder, as someone who runs one of the most important rates businesses in the world, what do you think about Kevin Hassett as a pair of hands to run this Federal Reserve?
I will say that I'm not going to comment on any individual. The thing I will say is I think this Fed will continues to be one that will analyze the data. I think the data is clear today in terms of where it's going. I think the thing that we've got to do as market participants is think about not just what are they going to do with the front end of the yield curve, but what do you do out further on the yield curve. There's a bunch, including with the name you mentioned, how people think about how does the 10-year react, how does the back end react to that. I think one of the great expressions of the market today is I actually don't think that rates are going to be that volatile out the curve going forward. And so, one of the great expressions of the market today is selling volatility in the rates market, which has been pretty good trade. And I think will continue to be. Mortgages, agency mortgages also being an evolution of that.
Mortgage rates and consumer borrowing costs are still high by recent standards. It's part of the reason, I guess, you want to get the terminal rate at 3%. But companies are telling us every day that tariffs and policy uncertainty are more important than the Fed funds rate to their business. And we talk to economists like Diane Swank who say that especially consumers at the lower end are not going to be helped by a rate cut. Anybody in the subprime borrowing area, which is massive, by the way, is like the bottom 2 quintiles of the country. Are we in a world where rate cuts just don't pack the same punch as they once did?
That is a long and complex question. So I will say the answer is yes. The short term, the overnight funding rate is not nearly as effective a tool at moving monetary prices, at moving the economy as it used to be for so many reasons we've chronicled before. Service-oriented economy, people borrow out the yield curve. CapEx is not driven by the interest rate today. It's driven by hyperscaler spend or by CapEx spend on AI, et cetera. However, long-end interest rates do matter. And how you fund out in the 5 to 10-year part of the curve particularly do matter quite a bit. It's part of why I believe that stability out the curve is so profoundly important. To say, though, the comment about getting the rate down doesn't help low-income people is not true. The truth is there is a transmission mechanism that even if you move the front end of the curve down, as long as the curve doesn't steepen that much, and there are ways to manage that, what you do is you create velocity of mortgages. You get the mortgage rate down, you create velocity of housing. It allows people to unlock value of their house. It allows labor mobility because people can move. There's so many, and by the way, whether it's credit card financing, whether it's auto loan financing, to say that it doesn't help to get that rate down, I think is, for particularly the place that it does help, housing, low income, small business, and that's what needs the help today.
Mortgage rates have come down. I mean, the 10-year is at 4.1%. This administration has been steadily moving it lower. Where do you think we see the 10-year, say, at the end of 2026, since the market believes that the Fed will cut rates to 3% or even a little bit more?
So, man, I think the key is, so the answer is I think it's going 3.5 to 4. And I think the key will be maintaining stability in and around 3.5 to 4, because if you get to 3.5 to 4, you get the mortgage rate into the mid to high 5s. If you get the mortgage rate down to the mid to high 5s, you see it today. Why is existing home sales picking up? Why are you seeing, we see it in prepayment speeds in the mortgage market. You see high coupon mortgages that are widening relative to low coupon as a result of the fact you are starting to see some velocity around housing, existing home sales particularly. So if you get the 10-year, which I think can happen in 3.5 to 4, you get the mortgage rate in the mid to high 5s. And by the way, I don't think it has to go much lower than that. That's where you get, what I think is a much more effective operating ecosystem in the economy.
How do you control, or how does the Fed, as you said, focus on rates out the curve? We have a viewer writing in who wants to know what's the mechanism to do that?
Many. So, if you are the Federal Reserve today, you have, when people say they have one tool, the Fed funds rate, I find that incredibly superficial. The handbook at the Fed has much more complexity to it. You can use the balance sheet, you can use their parts, if you use your voice, a lot of what Mario Draghi has done in the past, where you think about things like, gosh, if the amplitude of the curve is at a certain level, if the yield is at a certain level, you think about the size of the balance sheet relative to the duration, and you think about how you can be effective about using the long end of the curve. There's actually not that much, to get too technical, duration DV01 out the yield curve that you can be pretty effective at managing that relative to the front end. To your question, your point earlier, front end, the overnight funds rate is interesting, but it doesn't, moving at 25 basis points every 6 weeks, doesn't do a hill of beans for really, until you move it to where it needs to get to. Unless you're moving it quickly, it doesn't really do that much. But managing further out the curve where corporate finance takes place, mortgage finance takes place, structured finance takes place, that has real efficacy to it.
I got to ask about BINC. You've outperformed the market universally 1.6%, 1.6 times the return, 1.8 times the return of the ag. So I'm just looking at the ETF that you run here. How have you got BINC set up for the Fed cuts, the path that you expect, and I wonder how the massive investment in AI, the huge borrowing that these hyperscalers are doing to build out this global network, how does that touch BINC?
So yeah, it's a great question. Thanks for asking. So I'd say a couple of things. My job literally is, I'll say there's something I was looking at it the other day. Do you know in fixed income there's 1.4 million unique securities? So you think about all the tranching of the debt, publics, privates, et cetera. My whole job and what I'm trying to do with, oftentimes what I find with lack of wisdom, is all I'm trying to do is figure out what is the best value across the markets globally. Where do you take interest rate risk? Where do you take yield risk? Where do you take convexity risk? So all we're doing and trying to do for people, because fixed income is pretty complex, is use our teams around the world. So today, do you reduce a little bit of your investment grade credit? Because to your point, there's going to be a lot of AI financing that will come. We've seen it in the last few weeks. Do we need to own as much investment grade credit at tight spreads? Not really. It's not that exciting. Agency mortgages are more interesting. European high yield, European investment grade, we're not seeing as much of that AI, and the growth is moderate, and you get a cross-currency benefit. That's exciting. Having some interest rate exposure in places like Asia or in parts of the emerging markets. So I don't know, the idea being just try and move around dynamically to where the best relative value is around the world. Today, credit is just okay. We still own, we still like high yield. We've reduced some U.S. Just because spreads have come in a bunch. But we're just trying to create, if we can create 6.25 yield for people, stability. The thing I'm most proud about is we keep our volatility down. That's in fixed income. If you can get 6.25, and then take the risk in equities, to your point about AI and spend, pretty spectacular returns if you get it right around where the equity opportunities are.
Well, it has been. I'll tell you what, Rick. I put the Bloomberg data on your ETF, on BINC, into ChatGPT, and it came back with this. It says BINC has outperformed broad benchmarks by a wide margin while taking notably less risk. It's delivered equity-like returns versus the ag with roughly half the volatility, and it's captured most of high yield's upside with much smaller drawdowns. So high praise.
Thanks for saying it.
High praise from ChatGPT 5.1. BlackRock's Rick Rieder, that's just one of the many reasons we have him on this program. Really appreciate your time this morning. Let's get a check on what's going on in the stock market right now. You've got some gains here. We're up about 1/4% right now, and I'm just watching for the records. I like the superlatives. Right now, we're trading at 68.71, and we have to go another 1/4% in gains until we get an all-new record. But it just, to me, is amazing that we're looking now at two weekly gains in a row after such a tough November, so much volatility, that we're back at an all-time high. Broadcom putting up a 1.5% gain. That adds 3 points. Google putting up a 1% gain. That adds 4 points. Amazon putting up a 0.5% gain. That adds 1.5 points to the S&P 500. NVIDIA on the downside is not enough to drag us down. So it's off 1.2, 1.3%, and that does take 6.5 points off the S&P. But because we see 277 gainers and only 224 losers, it's not enough to drag us off. Apple, Netflix, and Microsoft also a drag on this index. Coming up later on in in the program, the University of Michigan's Director of Consumer Surveys, Joanne joins us because, as I said, we have the release of a ton of data, including the latest consumer sentiment read. We'll get it all to you, plus more on the Netflix deal to buy Warner Brothers Discovery. This is Bloomberg Open Interest. Time now for our top call. Some of the analyst action in focus this morning. First up, CFRA is raising its recommendation on Five Below to a buy after the discount retailer reported blowout third quarter numbers. Blowout is their term, not mine. A number of Wall Street firms are also raising their price targets on the company. So you can see Five Below up 2.5% in today's trade. Next up, Jeffries is upgrading Humana to a buy, saying the insurer's risk reward is more attractive. The analyst sees Medicare Advantage membership growth of over 20% next year, and you can see Humana in a decent market is up a lot more, 3.5%. The target 313, so we're still a ways away from that. And finally, Synchrony is getting cut at Baird. The firm says the bank's solid fundamentals are now overshadowed by its heavy exposure to lower income consumers, which makes the stock harder to pursue after its recent run. You can see that they have a hold. The stock's down 1% and the target's at $82. So still a little bit away from here, but not the kind of thing that analysts like to slap a buy on. Coming up, BlackRock's Bitcoin ETF recorded its longest streak of weekly withdrawals since the debut in 2024. More on the crypto route's impact on the ETF space next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. We are continuing to see gains in the few minutes of cash trading thus far. The S&P 500 up to 6877. The NASDAQ gaining 0.5% to 25,720. So these gains have been driven largely by tech. But as we saw just moments ago, NVIDIA is not participating. NVIDIA off right now just about 1%, a little bit less than it was before. Facebook, big gain on news today that it's going to, or as we get news today that it's going to make some partnerships with a number of media outlets. Netflix is down on its offer for Warner Brothers Discovery. It's a $72 billion cash and stock offer. It's not down too much now, only 7.8%. Warner Brothers up 3%, but not to the offer price. $27.75 is the offer price, and right now we're at $25.30. You can see Bitcoin here. That's the Bloomberg terminal code for it, XBT, XBT currency. I think it's interesting, although we chose that in the early days of the asset. Right now down 2%, just over $90,000. And iShares Bitcoin Trust down 2.4%, obviously moving pretty closely to the underlying asset. Investors have pulled more than $2.7 billion from BlackRock's Bitcoin ETF in the 5 weeks leading up to this month, a record run of outflows as Bitcoin tumbled. Bloomberg Intelligence analyst Athanasios Sarafagis joins us now for our weekly ETF roundup. Athanasios, how closely does the ETF track the underlying asset? I mean, is it really a one-for-one move?
Oh, hey, good morning, Matt. Oh, yeah, and this is why this Bitcoin ETF has taken off so quickly. It's because it tracks Bitcoin so well, right? And it's one of the easiest ways to get exposure to it. But to your point about the outflows, yeah, it's suffering a couple weeks of outflows here. Some of it could be sentiment driven, just obviously based how much Bitcoin is off of its all-time highs. But the other thing is this ETF was adopted really, really quickly. It's one of the most heavily traded ETFs, period, not just within crypto. So when you have that, you have a lot of different investor types that pass through that product. You have buy and holders, you have shorters, you have hedgers, you have institutions. So that tends to make the flows much more volatile just because you have a much more wider investor base. So I think some of it, to your point, is sentiment driven. The other point of it could just be some people making year-end tactical changes, maybe some tax loss harvesting here, just kind of taking some money from its drop from the top. So yeah, this is, there's obviously a lot going through that ETF.
What is the competition like for IBIT? I mean, there are clearly other ETFs. What are the cost bases like? Why is this the number one choice?
Yeah, if you remember when these all launched, a lot of them came out on the same exact day. I think, one, you can't ignore just the brand name. It's Blackrock. I think a lot of people trust that name. That said, several Bitcoin ETFs did take in quite a bit of money alongside Blackrock, but what their main advantages over the other ones is just that tradability and that liquidity, and that tends to attract the much bigger fish, which is why most people just tend to now default to IBIT. But that said, Fidelity's got some decent assets in their product Bitwise, so there's been some pretty decent adoption. But it's almost like comparing SPY to some of the other ETFs. There's one that just tends to be bigger and more liquid, and that's just what was happening with IBIT as well.
All right. Thanks so much. We have a break coming. I'm running up against a break. Otherwise, I'd have a million other questions for you about ETFs and the SEC that have come up this week, but we'll talk about those throughout the day and next week. Athanasios Serafagas of Bloomberg Intelligence, one of the triumvirate of our ETF specialists, together with James and Eric. Tune in to ETF IQ on Mondays. You'll see that whole crew usually. It's at 12 p.m. Mondays, New York time. Let's take a look at what's going on in markets right now. We're up on the S&P 500 by 1/3 of 1%. The NASDAQ gaining by 2/3 of 1%. Small caps still down a little bit, but we're going to get a ton of economic data in about 4 minutes' time that could well move the market, including consumer confidence. And for that reason, we're going to talk to the University of Michigan's Joanne. I'm sorry about last week, but Ohio State really deserved the W. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Danny Berger is on assignment. I'm on record watch for the S&P 500 right now, trading at 68.80 and 68.90 would be a closing high. 69.20 would be an intraday high. All that to say that we're just a stone's throw away, really just a couple of tenths of a percent away from either of those numbers. We do have breaking economic data crossing the terminal right now. We're getting a ton of it. So personal income, up 0.4 of 1%. The survey was for 0.3 of 1%, so a little bit better than had been anticipated. Spending bang in line and less than what we saw last month. Spending is up 0.3%. Last month we saw 0.6%. I'm going to talk to Michael Ball about this in just a moment, and as he points out, some of this is dated. We are getting PCE numbers as well. The PCE index year over year, 2.8%. And that's exactly what the expectation was, but a little bit higher than the prior reading. So the core PCE, I should say, price index year over year, 2.8%, a little bit lower than what we saw last month. So bang in the middle of those, but of course it's the core PCE that the Fed probably pays the most attention to. In terms of sentiment, University of Michigan sentiment coming out right now at 53.3, and that is better than expected and better than the previous reading. 52 was the survey and 51 was the previous reading. This is, I guess, a good number, especially when coupled with the fact that inflation expectations, according to the University of Michigan, have fallen. 4.1% is the one-year inflation expectation. We were looking for 4.5%. 3.2% is the 5 to 10-year inflation expectation. We were looking for 3.4%. Let's break it all down with Bloomberg macro strategist Michael Ball. And Michael, as you point out, some of this data is delayed and old and may not move the market much. But actually, I take a look at the 2-year yield, and it's done a whole lot of nothing right now. So
yeah, I mean, right in line. And with the PC data, by that time we've had CPI, PPI, we had the import data. So we already have the model. We know what it's going to be, and this was right on. Again, it's not really going to change the narrative next week. There wasn't expectations for it to do that. But, it's good to see the data again in a lot of ways. And now we're going to start getting more updated data, and people can get used to, again, getting the calendar back on their radar.
I'm going to talk about the University of Michigan, the consumer confidence numbers with Joanne. Right. Why not go straight to the source in a minute? But I want to talk to you for a moment just about my interview with Rick Reider. And I've just been in awe of the outperformance of his ETF. He's been absolutely crushing it. I mean, beating the benchmark by a lot, almost double, doing it with a lot less risk, half the volatility of the ag with these I say equity-like returns, but it's done better than the S&P 500. So what do you think about his performance and his take?
Yeah, he had an early take on being long in the belly in the first half of the year, which worked. And I think he's been right to say that being short rate vol has been a pretty high Sharpe ratio trade and it's paid off well. And I think, funny enough, we're having an internal debate here on the MLive team if that's going to change, especially with the new Fed chair Hassett coming in and kind of opening up the path, the distribution path of where inflation can be, where rates cuts can go, and basically giving more uncertainty, which in theory should be higher rate vol. But to his point, that's not what we're seeing yet.
He didn't want to say anything about Kevin Hassett. He didn't want to.
Well, he's in the running as well, so I guess he has to be.
I think it
play
would
his
be.
cards.
I think it would be. Look, Donald Trump is a president who loves to surprise people, right? And he can occasionally change his mind. Remember, he hated TikTok. Now he loves TikTok.
Yeah, well, yeah.
It would be interesting if, especially given some of the scathing commentary, like Neil Duda's commentary on Kevin Hassett as a choice. Like, what if the president did go with Reider instead of the Kevins or?
I'm waiting to see more official TBAC, which is the Treasury Committee that really kind of is a group of people from the primary dealers and other sort of sources that are really in the thick of things in the Treasury market, give somewhat of a more official stance on what Hassett will do. And I don't know if that's coming, let's be clear, because this echoes that FT article where they saw a lot of rebellion. And we're obviously hearing it around the news floor that there's a lot of concern across the street that if the independence of the Fed really does lose credibility, then we're going to have a whole world that we've never seen in a long time.
All right, it's fascinating to watch, and of course I read your blog to keep myself informed. You can get Michael Ball's work by typing MLIV GO on the Bloomberg terminal. Now let's talk about those confidence numbers. Joanne Shu joins us from the University of Michigan, where she is the director of the surveys of consumers there. And this one looks particularly good, Joanne. Do I have that wrong? You know, just on the headline, the number beat expectations and was better than the prior reading, and inflation expectations are lower than the survey and lower than the previous readings.
We're absolutely seeing some improvement from November. I think the inflation expectations numbers are definitely moving in a favorable direction, both in the short run and the long run. So that's definitely welcome news. We also saw a little bit of an increase in overall sentiment, but it's not large, and we're still at very low levels, historically speaking. So consumers are not feeling confident about the economy, but they're certainly feeling no worse. And they are starting to feel a little bit of relief on the inflation front, on the inflation expectations front. They're still expecting inflation to persist. Don't get me wrong about that. However, they're not feeling as pessimistic about it as they were in previous months.
How much does this actually affect spending? Like when you look at the mood of the consumer or inflation expectations of the consumer, how much does that follow through into actual consumption decisions?
One of the things that I think is important to look at are differences between now and the 2022, the height of the inflationary episode right after the pandemic. Now, historically speaking, when people feel confident about the economy, they tend to spend more. When they feel less confident, they tend to spend less. But in 2022, they felt very unconfident, but at the same time, they were willing to spend. The one key factor back then was that labor markets were incredibly strong, and people felt very, very confident about their incomes. So even though they didn't feel great about high prices, they had the strong incomes to support strong spending. Right now, we're in a completely different situation where consumers across the board are telling us that labor markets are weakening. We have, more than 2/3 of consumers telling us that unemployment rates are going to rise in the year ahead. So the strong incomes that would normally support spending aren't really there now. Now, higher income people might still be willing to spend, but middle and lower income folks, they're likely to be looking for value.
When you say middle income, I would think you're talking about the 50%, but I'm guessing it's more like the 80%, right? I mean, how does this break up in terms of quintiles?
There isn't really a threshold here. It's sort of both an intersection of income as well as wealth. The highest wealth consumers with large stock portfolios, they have stable incomes. They also have large portfolio values with the high stock market performance this year supporting spending. Folks with smaller portfolios or no portfolios at all, or feel like their jobs are potentially threatened over the next year, they're the ones who are going to be less willing to go out on a limb to spend. They may still be willing to spend while they do have their jobs, but they're likely going to be looking for value and being choosy with where they spend their dollars.
When you do look at the distribution of income, though, Joanne, I would imagine that the mean is way higher than the median. How far up is it?
I mean, that is always the case because the distribution of both income and wealth are highly skewed, and that's not specific to this moment. That's been that way pretty much since we started collecting data nationally about income. So it is true that median income is much lower than the mean, and the folks at the top just have a lot more economic size to spend, and that's part of the reason why with aggregate spending, it's really the high income, high wealth folks that generate the lion's share of that.
All right, Joanne, great speaking to you. Thanks very much for your time. And it was a valiant effort over the weekend in the big house. A lot of snow there. It's a tough team to take on. At the beginning, I was a little worried at the beginning that Michigan was going to have it. But being from Columbus, Ohio, I'm not unhappy about the outcome. Joanne Shu there of the University of Michigan talking to us about consumer confidence. Let's get a check on what's going on in the markets right now. And we are looking at pretty much a closing record now. 68.89 is the level that you see on the S&P. 68.90 is the closing record. So we only have to climb really half a point before Romaine Bostick can talk about that on the close today. The NASDAQ gaining 0.8% as it is. A lot of the tech stocks that are pushing us higher, and the 10-year yield right now at 4.1156, so holding around those levels. In terms of single stock movers right now, Hewlett-Packard delivering a sales outlook that fell short of high expectations for the AI service business. But Caroline Hyde says, hey, first of all, it's HPE now, not Hewlett-Packard. And secondly, they just need another quarter. Ulta Beauty raised its full-year outlook after seeing strong demand for cosmetics in the third quarter. So Ulta Beauty is up more than 10%, a 12% gain for Ulta. And Netflix, this is really the big story of the day, buying Warner Brothers. Not just the day, right? It's a massive, really an historic deal. $72 billion is the price tag that Netflix will pay in cash and stock to buy one of the most iconic and oldest studios in Hollywood with more than 100 acres of movie shooting space there in Tinseltown. And just absolutely massive. I want to get more on this deal with Bloomberg senior M&A reporter Michelle Davis. Thanks so much for joining us. So first of all, how do they fund this? It's a ton of money, right? And I saw a story in the terminal. They've already got banks lined up to do the financing.
So Wells Fargo is leading a massive bridge loan for them, about $60 billion, which will rank as one of the biggest bridge loans of all time after, AB InBev's big deal a few years ago. It's going to be investment grade. This is a massive deal and a big kind of surprising turn of events because it was just a couple weeks ago that everyone was expecting Paramount was going to clinch this. They were the ones that had made the initial unsolicited offers for Warner Brothers, and you'll remember Warner Brothers then ran a very competitive process that even this week seemed really unpredictable. So, well,
I mean, it could still turn out that way, right? Because Netflix has, I read this morning in your coverage, a $5 billion breakup fee. That's what they've offered, which is equal to what Paramount had offered. But the Ellison family at the top of Paramount is very close to the Trump administration. And so if you saw regulators block this, because there is antitrust concern between Netflix and HBO, Warner Brothers Discovery could pick up that $5 billion in breakup fee and still sell to Paramount for $30 a share, which is a higher offer.
Well, and even before that, I mean, it really isn't over because yesterday Paramount basically laid the groundwork to potentially go hostile for Warner Brothers. It published a letter that it had sent to Warner Brothers saying, we don't think that you've been running a fair process. And basically the thought is maybe now in the coming days they might come in with a counteroffer, or they might wait to see how regulators weigh in on this deal for.
All right, well, I continue to watch your coverage. Thanks very much. Michelle Davis there covering this for us on the BN side of the building. We're going to have more on the Warner Brothers Discovery Netflix deal later this hour. Brian Weiser of Madison and Wall is going to join us to give us the analyst take. Coming up, Amanda Agati of PNC Asset Management Group on what she sees as the next catalyst for markets and whether or not the purple haze of policy is behind us as the leader. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. The U.S. is quietly lobbying the EU to block a plan to use frozen Russian central bank assets to secure a massive loan for Ukraine. Washington argues the funds should be saved for a future peace deal with Moscow. Europe is divided, with Belgium, Hungary, and Slovakia resisting the proposal. Germany insists the money must support Ukraine. EU leaders will debate the plan later this month. The White House is warning that Europe faces, quote, civilizational erasure. The administration is blaming economic decline, censorship, and immigration. The National Security Strategy report was published overnight and signed by President Trump. The document says the continent will be unrecognizable in 20 years or less if current trends continue. And Bank America CEO Brian Moynihan is upbeat about the state of the consumer and U.S. growth. He spoke to Bloomberg's Francine Lacroix in London after the bank's investment day, its first in almost 15 years.
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money are 70 million consumers who's pushed about $4.5 trillion plus in the economy every year. They pushed in about, for that month, about 4.5%. And so it was good. And around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good. And it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, you know, that's their thing. But everything we see in the consumer side sets that up.
All right, let's take a look at what's going on in the markets right now. You can see that the S&P 500 is higher than the closing record. The all-time high was 68.90. We're looking at 68.94 here. The NASDAQ up 0.9%, so gaining momentum into the session. Amanda Agati, PNC Asset Management Group Chief Investment Officer, says valuations are getting rich. She writes, though, that markets need a new catalyst to keep the rally going, and a Fed committed to an easing cycle would help. Amanda joins us now, and you know, it's interesting, Amanda. I've been following you for quite a long time, and I love the purple haze of a policy, and we've really seen corporate leaders reference that as a reason for concern. That and tariffs, right? Ahead of rates, saying that rate cuts aren't necessarily going to help much when they're worried about those two things. Is that changing?
Well, it's great to be with you. Thanks so much for having me. And I'm thrilled that you've been talking about the purple haze of policy uncertainty, because I certainly have been talking about it as the primary driver of markets this year. I do think we're getting a little bit past peak tariff uncertainty. And so I think the headwinds as it relates to concern around tariffs in the new year will be less than what they were this year. The market's starting to work through what the impact of tariffs ultimately are. Of course, the wild card is what happens with the Supreme Court. But this is much bigger. The purple haze of policy uncertainty is much bigger than just tariffs, even though that has been a doozy this year. We have a decent amount of uncertainty around Fed policy, monetary policy, who the new chair is, likely some guy named Kevin, which I've been joking about all year as well. But certainly there's a number of other fiscal policy challenges potentially in the new year. We have the midterms that could, potentially change control. That's going to be uncertainty for the market. And then I don't want to sort of underestimate the geopolitical tensions that are swirling. So we are making some progress as it relates to the purple haze, but I continue to believe that's going to be a dominant force next year. And I'm really looking for the opposite of purple haze in 2026. I think it's just going to take us all year to get to maybe nothing but blue skies.
Well, the bull case, Amanda, is that, policy is leading to a ton of stimulus, certainly for higher income people and corporations, right, because of one big, beautiful bill, but also for some on the lower end of the spectrum who have to pay fewer taxes on Social Security or overtime or tips and what have you. Is that, combined with the amazing investment we're putting into AI infrastructure, almost guaranteed to push us higher if the Fed cuts rates?
I love a guarantee. I don't think that's a guarantee. that I want to, bank on necessarily because of this overhang from policy uncertainty. You're absolutely right. The fundamentals all year have beat expectations on a relative basis. Everybody sort of thought the fundamentals were going to fall off a cliff, and yet we've continued to kind of build momentum and exceed expectations all year. We're setting the stage for a continued acceleration from a both economic growth and earnings growth perspective next year. It's all good. I want the fundamentals to continue on this trajectory. The challenge is the unknowns around policy uncertainty that I think can get in the way when you have valuations that are sitting at these levels. It just doesn't leave a lot of headroom or shock absorber when some of these negative policy variables come into the equation. I still think next year is a great year. I think it's a home run in terms of the trajectory for the market, but I don't think it's going to be a straight line from here until this time next year. I think there are going to be some bumps along the way. What are the biggest problems? I mean, is it the lower income consumer here? We're starting to see things like subprime auto loans, the biggest default rate on subprime that we've seen since record keeping began in the 90s. Is that a problem that Fed rate cuts just can't help and are going to be a drag on the economy? I think those are fair concerns. There's no question. I mean, just because the Fed lowers rates 25 basis points doesn't transform, the economy overnight. It's not so much one cut here or there. It's sort of the final destination. What does that mean for monetary policy? Are we going to get to a neutral rate early in the new year where it's sort of a Goldilocks scenario? Or are we going to go even further from that? So, we have our eye on the low-end consumer for sure. They've been under a ton of pressure. I think they're going to continue to be under a ton of pressure. The good news, bad news is that's not where the lion's share of spending has been occurring. And so, what matters going forward is that the consumer on balance continues to hang in there. We've seen that to be the case. PCE report this morning, a little bit weaker than expected, but that's old news, right? Right. Pun intended. That's from September. I think what you're seeing in terms of spending related trends continue to suggest that the consumer is going to hang in there well into the new year. I got to ask about the 12 days of Christmas, because you have at PNC a price list for those assets. Is Christmas getting more expensive? Oh my gosh, yes, that's an understatement. Christmas is definitely getting more expensive. We've been doing this fun analysis of the 12 days of Christmas. It's the Christmas price index for the last 42 years. And this past year, the analysis that came out just a few short weeks ago suggests that Christmas is about 4.5% more expensive this year on a year-over-year basis. So handily beating the BLS CPI level for sure. All right, so it is a specialty gift basket. So it's high-end consumer. That's a reflection of high-end consumer. That's who wants the partridge in a pear tree. Amanda, exactly. Thanks so much for joining us. Amanda Agati there from PNC Asset Management. Coming up, power may be running short as the AI revelation booms. That's an understatement as well. Revathi Advaithi joins us, Flex CEO, to explain. This is Bloomberg Open Interest. Let's get a check on the markets right now as we surpass a closing record at 68.93. We're just 3.5 points higher than the all-time high. The NASDAQ currently gaining 233 points to 25,814. So the market gets increasingly bullish as we get into this trading day. Coming up, we're going to talk to a real outperformer. Flex has undergone a complete transformation and now touches every major hyperscaler in the world. We're going to talk to the CEO, Revathi Advaithi, next. This is Bloomberg. A company called Flex has quietly become an integral piece of the global AI and data center build-out, delivering hardware necessary to run the world's biggest compute stacks. The CEO, Revathi Advaithi, is here to explain how she transformed this company that sells equipment to every major hyperscaler in the world. That, by the way, has led to a 733% increase in the price of Flex shares since she took the reins at the beginning of 2019. So welcome to Bloomberg. Thanks so much for joining us. It's a pretty astonishing
turnaround that you've made with this company. How did you know so early on that you needed to go towards AI before any of us had really heard about it?
Well, when I started with Flex in 2019, we're a traditional contract manufacturing company, which means we make a little bit of everything for every end market. Everything from health to automotive to industrial, maybe some data centers. And what we were doing, Matt, was, of course, making compute racks for data centers. But we had this little business that was making power that powered the chip itself, like the NVIDIA chips or any chip manufacturer. It was a small little business, and my whole legacy is with electrical industries. I came in and I thought, well, compute's going to get power hungry, and this is before the days, everybody was talking about NVIDIA and OpenAI, and thought, why are they doing all this power stuff? It's going to get intensely power hungry, so let's buy more things that puts compute and power and cooling together. So we ended up cobbling together a whole bunch of acquisitions. And one of the first companies that thought about compute's going to be power hungry, power is going to generate a lot of heat, which means you're going to need a ton of cooling. Let's try to bring all these three things together and provide a value proposition to the customer because it's so fragmented in how they're thinking about it. So I think it's just my history of being in the electrical space that helped this. And so we invested in that and built a business that today is around $6.5 billion, growing at 35%, and is 25% of our portfolio.
It's interesting because at the time, I imagine, Bitcoin miners would have wanted to buy your products as well. So were they an early first big customer and then it's transformed into a data center play?
No, we're always with hyperscalers and colos. So Bitcoin miners.
Colos being co-location.
Co-location companies. So those were the two major players. We've got a lot of neoclouds today that we work with. But traditionally, if you think about hyperscalers and colos, they're the ones designing the compute. And compute, by the way, is going from being 10 kilowatt racks to 1 megawatt racks, generating a ton of heat. And you have to cool it down, and you have to make sure power is migrating safely across this value chain. And that's what we do.
By the way, you essentially control the last mile or the last, let's say, 500 feet of the U.S. power grid, right? What do you think about the problems we hear about in the rest of the big grid, that the utilities are feeding into?
Yeah. So, Matt, I've spent my last couple of decades in the energy space, and I recently say this often is, as to go and see all these utility CEOs and, when I ran Eaton's electrical business and begged them to spend money to upgrade the grid, and you wouldn't hear anything from them. Now I think it's super cool that the data center acceleration is forcing us to talk about upgrading the U.S. grid because it's so important. Our transmission systems are outdated. Our distribution systems are outdated. So I'm really excited that this is the chance for the U.S. to upgrade its infrastructure for energy because without good, cheap energy, and I know there isn't good economic growth. So we need to make this happen. And the spending that you're seeing that is being announced now, which is not just in distribution, but also in transmission, will help this pretty significantly.
I mean, we're starting to understand your role in the energy to compute sector. Is the administration reaching out to you as an expert in this area and asking what can be done to improve things?
Well, I think the administration has put a lot of focus on providing the right energy policy for data centers and industries to be able to invest in this kind of an accelerated spending. Without the administration support, that wouldn't happen. I think that's one big thing where we play a role. And then the second is being one of the world's largest manufacturing companies. Everybody is talking about U.S. manufacturing. We definitely play a role in having the conversation about what does it take? How do you make sure you have good, cost-effective manufacturing systems and capability in the U.S. and how we can support? So we're very excited to be able to help play a role in this.
So you're building a lot here in the U.S., but you are present in, I think, 25 or 30 other countries, right? Mm-hmm. Obviously, this AI data center build out is something global. Outside of the U.S., where do you see the most demand, the biggest investment, the highest CapEx?
I would say our biggest presence is in the US and in Europe. So we have a very significant presence in Europe, in Ireland, in UK, in Poland, where we kind of supply to almost all of Europe for data center infrastructure there. And we don't have a big Asia Pacific presence just because of the geopolitics issues associated with it. And I would say European infrastructure spend is okay, but the US is now basically consuming most of the infrastructure spend for most hyperscalers or colo. Everybody's focused on the US is going to go from what used to be 20 gigawatt of data center power to 100 gigawatt in the next few years. So we're all focused on making sure the US has the right resources and capability today. I'd say European spending is happening, but not to the scale that we're all allocating capital to here.
By the way, 100 gigawatts is like 10 Manhattans.
Correct.
Are we going to eventually have as much compute power as we currently use to power the nation?
I mean, that's what it seems like. And even that doesn't seem like it's enough, right? We have, some $8 trillion of capital spending being announced in this space. I think it's going to be needed. And as a manufacturer, Matt, it's important to see what I see, which is that the AI journey has barely started. Because we're talking about consumer use of AI today. You look at manufacturers like us, productivity in the manufacturing space has stalled for the last decade. When we use AI in our factories, it's going to be a game changer for productivity that we're going to see. So I'm a huge fan of, we're going to get more and more compute intensive, and that's going to happen not just in consumer behavior, but in factories like ours. And that journey is really just starting. So 100 gigawatt is definitely happening because industries like mine need it.
By the way, Revathi, so when we talk about data centers, it's power that's the scarcity we're focused on, because you don't really need a lot of people working in data centers. But you do need a lot of people to manufacture your products. How are you finding the scarcity of labor?
I'd say labor is scarce. It is difficult, not straightforward. One, because, I have to say, it's not that everybody wants to apply for manufacturing jobs. It's not the coolest, sexiest thing in people's heads. But in the cities that we are in, I would say we're a very important part of the local economy, and we provide good jobs that takes the skill sets that people has and really build on it. So, we have a lot of open jobs. We're competing with many different industries for it. I think availability of labor is the biggest issue in the United States today. But I like the fact that in the cities that we're in, we provide employment that people want to be in. And I think manufacturing is cool and sexy. I'm not sure what everybody else thinks about it. So, I've grown up in factories all my life. And so it's a tough fight, but I feel like we're making progress on that.
All right, great to have you here. Hope you come back soon. Revathi Advaithi there is the CEO of Flex, and they make equipment that every big data center needs to buy. Let's turn now to one of our top stories today, the top story, really. Netflix spending $72 billion to buy Warner Brothers Discovery in an historic deal that marks a strategic shift for the world's most important paid streaming service. Joining us now is Brian Weiser, Madison and Wall principal. And Brian, when I saw this morning, I thought, I guess this means they got it, but they haven't really gotten it yet, have they?
No, I don't think so at all. This is going to play out over who knows how long, probably the better part of 2026. The politics of this will be inescapable.
How else could this turn out? Because it would be interesting, I think, if, since they've offered a $5 billion breakup fee, Netflix had to walk away, and then someone else would be able to make an offer that's essentially $5 billion lower than what Warner Brothers Discovery would have wanted.
Yeah, I mean, that's absolutely a possibility. I don't think it's the case that Netflix is the one who would walk away. I think it's just that, or not least voluntarily, I think it's that the risks are that the pressure that they'll face from governments, I mean, put the potential for crony capitalism aside here, there are real legitimate issues that will need to be considered by the European Union as well as the U.S., other jurisdictions, and it may just be outside of their control.
Of course, though, I'm sure consumers would welcome one fewer streaming service bill, right? I mean, you're already paying for Amazon, HBO, Netflix, Apple TV. The list goes on and on. It's really the crony capitalism issue that I think is the most interesting. Because the Ellisons are so close to the Trump administration, I would have thought that Paramount is a slam dunk.
Yeah, I know. I think that was my guess as well. Again, we can't rule out that this happens. It could very well happen. And I think that, to your point, yes, I think consumers might welcome one fewer subscription. This could be a much more consumer-friendly choice. But, at the end of the day, there are a lot of people with Paramount Plus who could have a combined Paramount Plus HBO Max subscription too.
So what about the offer? I mean, $27.75 was what we got from Netflix. Warner Brothers Discovery right now trading at $25.35. Is this just, typical deal mechanics that we don't get to the offer price right away? We certainly haven't gone above it, so it doesn't seem like the market's betting on Paramount's $30, reportedly, $30 bid, taking a win.
There's so many possible scenarios to account for. Again, it could very well be that this is sort of where the price is, whoever ends up with it, right? Because again, Netflix may end up having to walk away whether they want to or not. So we don't know how that plays out.
Brian, David Zaslav has been pretty clear that he wants to get the best deal for shareholders at the end of the day, which is great. That's his job as an agent of the shareholder. How much will a Warner Brothers Discovery shareholder actually get if they spin off their cable assets and then still get $27.75 a share from Netflix? What does that add up to?
Well, again, I think that has to play out. Also, keep in mind that I think part of the deal involves actual Netflix shares, and that could actually be worth something to individual shareholders. Again, we're much more focused on trying to understand what the business mechanics are of this and what it means for the industry, because I think that's where the most profound consequences are going to be. When you have one player that might have 17% of content spend on our estimates, one player that might actually have all sorts of new bundles that would create a potentially new advertising business, because frankly, how are you going to justify a $40 monthly subscription to consumers who are used to paying $20 monthly subscriptions for two separate services? That's going to be hard to handle. I think they might actually be really well positioned to expand the advertising business, if anything else.
All right, it is truly fascinating, Brian, and we were happy to get your take. Hope you can join us again soon. Brian Weiser there of Madison and Wall talking about what the end result could be if this Netflix Warner Brothers deal does go through. Coming up, Gen Zers are taking to the streets in Nepal and trying to force government changes. Wall Street Week is in Kathmandu with a first-hand look at the implications. This is Bloomberg Open Interest. Time now for our Wall Street Week conversation. In September, demonstrators in Nepal took to the streets, burning buildings and forcing a change in government. Michael McKee traveled to Kathmandu to find out what's behind the unrest.
I was tired of living in a country where not my capabilities or my competence, but the connection that people have takes them forward.
We plan to have a very small, peaceful protest.
Did you stay off of social media or did you go back to posting?
No, went back to posting. I will never stop posting. It's fine even if I die, but I will be dying speaking up for my country.
There is a huge class difference, and all these people, they get these opportunities not because they are capable of it, just because they know somebody.
Madagascar, Sri Lanka, Philippines, Maldives, East Timor, Nepal.
Government properties being demolished, burned down. Did we ever think that we will be targeted next? No.
The big question is, how many other similar countries does this spread to?
Now more than ever before, people have a window into the lives of others. Social media connects youth across countries and continents, but it also shows them riches beyond their reach. And as inequality and unfairness become more conspicuous, some Gen Zers have taken to the streets. But nowhere was the movement more visible and more violent than in Nepal, a small democratic country wedged between Tibet and India.
We were marching towards the Parliament gate, and I was always very opinionated. I used to have opinions on everything. I was a rebel kid. This video is about me asking.
Prashamsa Subedi is a 22-year-old law student who lives with her parents in the outskirts of Nepal's capital, Kathmandu. Not long ago, her life took a surprising turn.
It was 2024 when I started uploading the videos about my political opinion, what I felt the government was doing wrong, and that's when it took off.
In late June, after a Nepali politician downplayed the country's poverty, Subedi posted an angry response on TikTok. A day later, her clip had over 1 million views.
How can a leader, mantri say that? Ke? Before, when we think of it, these politicians would not have their life public. So we would not know what their lifestyle was, how everything was going. But then there is a very famous politician. One of his family members was a vlogger. And she used to document their lives, and every clip used to go viral. And people used to see what lavish lifestyle they were having, which we could not even imagine. So that is how it all sparked. That is how it all triggered.
And that was Bloomberg's Michael McKee reporting from Kathmandu. You can catch Wall Street Week every Friday at 6 p.m. New York time, and today will be a fascinating episode. Coming up, we're going to set you up for the trading week ahead with a Fed decision coming on Wednesday. This is Bloomberg Open Interest. Let's take a look now at what's ahead next week for markets. On Monday, Toll Brothers reports earnings after the closing bell, and with all the talk of the housing industry, that'll be one we pay close attention to. Not as closely as we pay attention to the jobs data, though. JOLTS data comes out on Tuesday, so we see the openings, the layoffs, and the firings as well. Wednesday, we're going to get the Fed decision. So we'll watch for what right now traders are betting will be a rate cut. In fact, if you look at the world interest rates probability, you can see that there's a 95% chance of a cut being priced in by futures. On Thursday, we get more earnings. Costco comes out, as well as Avgo, Broadcom coming out with earnings. That's a big one and does tend to move the market. And then finally on Friday, we'll get Fed speak, picking back up again with remarks from Philadelphia Fed President Anna Paulson. But of course, that'll be after we get what looks to be a rate cut on Wednesday. Let's get more on what to expect from the Fed with Ira Jersey. He's Bloomberg Intelligence Chief U.S. Interest Rate Strategist. And Ira, it does seem a little bit surprising to me that the Fed hasn't said, okay, you know what, we're going to push our meeting back a week so that we get the big jobless numbers. Those have been pushed back themselves, and it seems important enough to change the schedule. Not going to happen, is it?
Yeah, well, they would have done it already had they thought they were going to move it. You know, it is a little bit earlier in the month than it often is. It's usually kind of the week before Christmas that the Fed meets. It happened that the 6-week cadence turned out to be next week instead of the week after. You know, I don't think it would necessarily change their opinion. Look, if one number is going to change the path of monetary policy, then you know, that takes data dependency even a new level, and I don't think that the Fed's quite there yet. I think what the Fed is saying to themselves, and you know, they probably won't disappoint the market, is look, we'll cut in December, kind of another in this string of slow cuts and stop cuts that we've done over the last 18 months. And then let's reevaluate. And we don't have to go in January if we don't want to. If 25 basis points is going to make or break the U.S. economy, we have much bigger problems. And they can reevaluate after they have all of the data kind of caught up, and then decide in March if they want to continue their slow cutting cycle. So the thing is, watch the SEP, watch the dots. That's what's going to really move the Treasury market.
The thing is, it doesn't seem like 25 basis points will break the economy. What's going to break the economy? This rate doesn't feel restrictive at all to anyone, right? I mean, stocks are at an all-time high. Spreads have never been this tight. Unemployment is still far less than 5%. And that with no new labor coming in, no new immigration, means that, you know, those who can work are going to be in greater and greater demand.
Well, you know, the labor market, some of that data does tend to lag the rest of the economy. And when you look at things like hiring intentions in a lot of the survey data, those don't look particularly good. And that's something that the Federal Reserve looks at. And my view, and this is different maybe than the consensus, and certainly what you just mentioned, Matt, is that we are going to continue to see a modest slowdown in the economy, and the Federal Reserve wants to get in front of that. Under their rules and the way that they look at the restrictiveness of the policy rate, they think probably around 3% is the neutral rate. So they want to get to what they consider neutral. Now, you're right, financial conditions are exceptionally easy, but remember, that's predicated on what's being priced into the market. So if the Federal Reserve disappoints, those financial conditions, the stock market, credit spreads, and the like, would probably reverse somewhat if the Fed were to say, hey, we're not cutting at all anymore. So, so that's why the dot plot that we get next week for 2026 really matters.
It's a really good point, Ira. Thank you for making it. Thank you for joining us. Ira Jersey there of Bloomberg Intelligence. Coming up on Monday, Sinead Colton Grant of BNY Mellon, Sitara Sundar of JP Morgan, and Goldman Sachs Global Head of Credit and Asset Finance, Christina Minnis. This is Bloomberg.